Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning. This is Quincy Krosby. It is Monday morning, December 12th, and this is The Talking Point. Thank you for joining me. As I look at the market, it just opened, and it's all in the green, and, this can go back and forth all day long, of course. But one of the things that we saw from last week is that the market that had rejoiced and applauded Chairman Powell's comments when he spoke at the Brookings Institute, talking about the possibility of a softish landing, right? Remember, he talked about that. The market picked up what it wanted to hear from that discussion that he had. And then last week, the market turned. It turned and focused on recession. And that's all we heard virtually all week. Recession, recession, recession. Now, please remember, there are all kinds of recessions. There are modest recessions. And even if you are in the camp that the economy remains resilient, which it is, the labor market, despite continuing claims now continuing to rise, and I point this out at this moment, when continuing claims rise, as opposed to initial claims, it is suggestive of a labor market that is beginning to become more and more difficult. Typically, when we go into a recession, or signs that are pointing to a recession, the continuing claims continue to rise, because what it suggests is folks can't find other jobs as easily as they have been finding other jobs, again, for those who want to work. Now, this is the important issue, the question of the resiliency of our economy. The labor market, despite the continuing claims, actually is in full employment, 3.7% unemployment. The Fed can make that rise even more if it feels that it cannot expunge inflation enough, and it must actually push the labor market higher in terms of layoffs. Then, we're going to have an issue, because obviously the fear of recession will keep particularly small business owners quick to let go of workers. There is a thread in the labor market that has many of the corporations, maybe mid-sized corporations, not wanting to lay off people for fear that if we don't go into a deep recession and the economy begins to pick up, they'll have trouble finding workers. So they're hanging on. But how long will they hang on if they see a deterioration in the overall economy? That's a big question. So this is a very important week for the market, because we have the Fed, meeting this week, and we have the consumer price index coming out on the 13th, just before the announcement on the 14th of where the Fed is thinking, the press conference, and so on. But in any case, last week's market was about recession, and it was banks talking about that they're seeing a recession, they are looking for a recession. All it was recession talk. Suddenly, the comments from Chairman Powell about a softish landing dissipated. It just sort of evaporated, and we were left with nothing but recession. There must be a balance in here, because, again, recessions come in all flavors. Right now at LPL Research, we're looking for a more moderate recession, and I have to just stress this, unless the unemployment rate skyrockets, because the Fed is convinced that they will never find a balance, an equilibrium in the labor market where wages come down and the employers do not have to, offer very high wages to keep workers. The Fed may find that it has to go even more in terms of tightening conditions. Needless to say, the move in the wages from the last payroll report climbing higher as opposed to either leveling off or even coming down obviously had to just send shock waves through the Federal Reserve, because this is not what they want to see. It is the opposite. Still, let us remember, consumers still have spending power. They actually have money, even though in the banks, even though it's coming down, there's still enough to keep consumers liquid and spending, albeit maybe more with credit cards. But we're also seeing at the same time, to repeat, that the labor market is difficult. It's difficult to kill it. And we have to just keep our eyes on, again, how much is the economy tightening? Remember, there's the lag effect. It could be a year before we know exactly how these 375 basis points already in the system wind up hurting the economy. So a lot of this is fluid, and a lot depends on the readings of inflation. And so today, after this call is recorded, we're going to have a sense of the one-year inflation expectations and five-year expectations that comes out of the New York Fed. It's widely watched to see the expectations of inflation. Also this week, tomorrow, that's Tuesday, we'll have the National Federation of Independent Businesses. This is the Small Business Owners Report. Again, I watch it very closely to see how they see business conditions unfolding. What do they expect in terms of hiring expectations, in terms of spending on equipment, capital expenditures? By the way, capital expenditures across the board, they're higher, not lower. And I want to see what the small business owners have to say. And then on Wednesday, we have the Fed statement. And this is crucial for the market. Does Powell at the press conference, is he the softish landing Powell? Or is he, well, I'm prepared to, go really, really at this economy and bring down inflation by, causing a recession? We'll see what he has to say about that, because his communication skills, and you just had to see it, how the market applauded what he said at the Brookings Institute conversation, versus when he could sometimes come out and he's much more hawkish. We'll see where it is. But what the market is expecting right now is 50 basis points. One other thing about market expectations, and that is the market as it is, there are all kinds of metrics that we look at, actually indicates that it believes that in 2023 we are going to see rate cuts. Now, this is important because that would suggest that the economy goes into a deeper slowdown, call it a recession or very strong downturn. But the chairman of the Federal Reserve said that he expects that for 2023, the Fed would stay on hold. So in other words, they'll get that last rate hike, where, by the way, the market is expecting it to be around the terminal area where the Fed finishes, around 5%, 5.25%, but that they will stay on hold for a long time. That's not what the market is saying. The market is saying, no, you will be cutting rates. Obviously, it's a long time between now and even the middle of 2023, let alone the end of 2023. But we'll have to pay attention to this. Now, the other aspect of this story is, what does he say about future rates? He's been very open about talking about, by the way, from the November 2nd press conference, saying that we would see a lower rate hike at this meeting. Remember, he said that. He said at that press conference, he said, yeah, we're going to downdraft. We're going to step down. And he said, you'll see it soon. He used that word soon. And he said, even at the next meeting, which happens to be this week. So again, the market is expecting 50 basis points. We'll see if he is as talkative about the next meeting that comes in 2023 and what he expects. Again, right now, the market is expecting another 50 basis point hike at the next meeting in 2023. But at some point, we'll probably move to 25, 25, 25. Now, this week, a tremendous amount of data, but it comes after the Fed meeting, right? So Tuesday, we get the National Federation of Independent Businesses, but here's the one that is the most important for this week. It is the Consumer Price Index. And so it will be looking at where inflation moved, not for the month of December, but for the month of November. And let us remember that tremendous rally that we enjoyed, the previous Consumer Price Index report that came out in early November. That moved the market dramatically. It showed that inflation is coming down. And what we also saw, which was important, we saw the 2-year Treasury yield come down as well. It didn't collapse, it just moved lower. And I always stress that's important because the 2-year Treasury is the most closely associated with Fed policy. What that did was it confirmed the equity markets rally, saying basically, inflation is starting to move down. It's not a mirage. It's not make-believe. And it is. What's missing in all of this is the rents. Rents are 30% of the average American's budget. And we want to see that come down. According to all of the industry reports that we look at, rents, new leases are coming down. And that will ultimately show up in the CPI reports. And we may see a touch of that in this report, but certainly after this, the one that comes out for December, the one that comes out for January, we will see month by month the number associated with rents, higher rents, the prices coming down. And I think the Fed knows this. The question is, how fast does it move? And obviously the market is paying very close attention to this. In addition to this, we're seeing energy costs come down as well. You could see that we are seeing oil prices down, and at the filling stations, the gasoline stations, gasoline prices also are coming down. So that also helps. Obviously, that is a headline number. The Fed looks at core, but we all look at, we don't live in a world of core, do we? We live in a world of headline and core, right? We live in food, we live in energy, we don't live in a cave. And so the Fed is more and more, believe it or not, looking at that, even though their mandate is to look at core inflation. Now, the other thing that we're going to see on Thursday, alas, this is after the Fed meets, are the continuing claims. And I'm going to stress this right now. Continuing claims are moving higher. When the unemployment rate began to show that initial unemployment claims picking up, folks were just getting jobs right away. But then we started to see continuing claims picking up. And the reason this is so important is it very often is a recession signal. Not at the level where we are now, but if continuing claims continue to rise and continue to rise, it very often points to a recession coming. And that would, by the way, match what we're seeing with the inverted yield curves in the Treasury market. Again, the 3-month Treasury note inverted with the 10-year Treasury, that has a stellar track record showing that a recession is somewhere over the next 12 or so months. Needless to say, the 2-year and the 10-year Treasury also still inverted, suggesting that recession is looming over the next 12 months. This is probably the reason that you're seeing in other markets saying that the Fed is going to be cutting rates sometime in 2023 because of a recession. Now, also in the reports, we're going to have the retail numbers, which obviously is important because we want to see how are we holding up. One of the things we're seeing is that we're not buying as many used cars, and there are indications that the new cars are not being sold as quickly as initially suggested by the data. This is extremely interesting because, folks can buy whatever money they have, particularly upper income folks just go out and buy it in cash, but most go in and take advantage of some of those loans. Those loans are becoming more expensive. This week also, we will have industrial production, and we will have the Empire Fed Survey of Manufacturing and the Philadelphia Fed Survey of Manufacturing. It's interesting because we are seeing, while manufacturing is being pressured, we are actually seeing companies spending money on capital equipment. This is important. It's telling us that companies are allocating in their budgets money for capital equipment. In fact, when the small business survey comes out, and that comes out tomorrow, the National Federation of Independent Businesses, I'm going to be looking for the following. I'm going to be looking for hiring expectations. What are they seeing over the next 6 to 9 months? And if they are spending money on equipment. This will give us an indication how the small business owners are faring and what do they see. By the way, most of the firing, letting go of workers is coming from small business owners who really have to cut costs when, revenue is coming down. What we're hearing from mid-sized business owners and large corporations is that they're being a bit more careful because one of the things they're worried about is if the economy just has a mild recession and the economy begins to pick up, let's say in the second half of 2023, do they have enough workers? So what we're hearing now is that they're keeping workers as best they can for fear that the economy does begin to pick up and they don't have enough workers. That could change, obviously, if recession fears pick up and the idea of a recession begins to say, hey, we need to cut more personnel. So there is an awful lot riding on what Chairman Powell says in the press conference. Remember, he was extremely, how shall I use the word, softish and dovish at his conversation at the Brookings Institute that caused the market to just rise and rise dramatically. We'll see which Powell comes out at this press conference. Is it softish landing, or is it we're prepared to have a recession in order to bring inflation under control? So a lot riding on his comments, but again, the market remains resilient in the sense that it is looking at both sides of the equation. And I think, meaning a recession or just a slowdown. His comments on Friday will help the market determine which direction we will go as we close the year. Thank you very much. Please don't hesitate to get in touch. And please pay attention to the leadership in the market. Let's see if the banks can start a reversal and start to come into this week adding to their little bit of a recovery that we saw last week. I'm still in the old school that says the banks tell an important story, and I don't think that has dissipated over these years. Banks at the regional level tell a very important story, and they have been the ones that have been suffering as we go through this dialogue of whether or not we'll have a recession. Please pay attention to them now and after the Fed has its meeting and Chairman Powell speaks. Thank you so much. Don't hesitate to get in touch. Look forward to getting back in touch with you to go over anything you want, where you want more clarification. Thanks again.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.